Hello everyone, welcome back to my channel. So this video marks the end of the week number 82 in this Road to 100k realized return challenge. And oh boy, what a week. I think this is going to be one of the longest videos I ever did on this challenge, because we have a whole lot of stuff to unpack here. And yeah, there were new events coming left and right all throughout the week. And so yeah, without further ado, let's get into it. So basically, um, starting out with the events as always that happened during the week, there is nothing here that is pretty much market moving on Tuesday. Monday, as you know, the markets were closed because of the President's Day. The video that I did on Tuesday evening also, yeah, didn't there was nothing remarkable about that. But of course we had much bigger fish to fry as the week wore on. So basically, on Wednesday, this is where things started to get a little bit more interesting. Never mind so much about what happened here with the durable goods orders. These were positive, of course, because it's minus transportation, which is the most volatile component of the durable goods. Still, they continue to decrease overall. They continue to decrease relative to the previous month. Previous month has been a remarkably positive and surprisingly positive in November, with a 5.4% increase, but for December, yeah, basically there was a U-turn, and durable goods orders were reduced by 1.4%, even though, of course, this is not as important because this was still a delayed report because of the government shutdown. And so this is the December data, so nothing really that interesting. More interesting was during the day, these minutes of the more recent Fed meeting on January 28th. These minutes were released, and it did not paint a very bright picture for the next few meetings when it comes to interest rates. Even though, of course, we all know that the current Fed chairman, Jerome Powell, will be leaving in few months, and Kevin Warsh will take over after. So there might be some. We cannot take this with 100% certainty, but of course this is a sign of things to come when it comes to interest rates. Apparently, again, there was a very strong division and a lack of consensus on where interest rates should go. And apparently, and this is also very interesting, there were talks about some rate hikes because, and as we know, inflation is still above the target, is still above the 2% target, and that it has been quite sticky and yeah, resilient. And so if it remains like that, and if further inflationary pressures come, the Fed may be forced to increase interest rates to keep inflation under control, even if that comes at the expense of the economy. And so, yeah, this is also something that is important, as it was also here on the headline. Further interest rate cuts should be paused for now and could resume later, only if inflation cooperates. And that means that inflation really must come down further, so that further interest rate cuts could be on the cards. And looking at here, for example, at the Qs, looking here at the weekly chart, this was around this time. Yeah, it was around this time that the minutes were released. Yeah, it was here at 2 o'clock, and this is the moment where basically the market came down, but then of course it rebounded towards the end of the day. But still, this was the initial impact. So investors did not took this very well, even though if this was a temporary downswing. Now, this we were building up and gathering pace because the more interesting stuff comes in the last few days of the week, on Thursday and on Friday, and so the jobless claims came quite positive, so less than expected. Now, here the trade deficit, this is as not as much of an importance. We must be honest, and especially because this is for December, so this is already quite late. But as you can see, the trade deficit for the month widened by around 17 billion. And here, this is the report from, yeah, but basically this is the news piece, and the trade deficit totaled 901 billion in 2025, and this was a bit less than 2024, and so this was probably the third biggest trade deficit on record, slightly below 2024 and below the record 923.7 billion shortfall in 2022. Now, looking at the report here from the Bureau of Economic Analysis, here you see, and you can see that this movement over here, looking at what happened over the course of the year, of course, the trade deficit widened quite a lot in the beginning of the year, which is normal because basically consumers and companies were front running the tariffs. They knew that the tariffs would be coming in the later months, so basically they front run them by importing as much as they could before the tariffs came into effect, and then later, of course, they compensated by bringing less importing by reducing a fourth amount of imports, which improved the deficit. The deficit came even to this low by around October, but then it continued to widen up, and this is where we stand. But of course, we need to keep in mind that this large swing and the reason why it was probably it was the third biggest one, also partly because of the front running of the tariffs at the beginning of the year. So here, as you can see, exports also were reduced, but this was a double combination of lower exports and more imports here. Now, looking here at much of the imports, basically this is metals and oil. And when it comes to the exports, we can see that most of the decrease was in supplies and materials, and also other goods, because all the other rubrics were increased. But I'm not sure. There may be also this decrease in exports, maybe some related to the fact that other countries are basically trying to steer away from importing goods from the United States. It could be, but yeah, we don't really know for sure. Now, when it comes to the imports, and we have to say that this was precisely what one of the objectives that the current U.S. administration tried to focus on for this 4-year term, is to basically reduce this trade deficit. But apparently this is not working out, because this trade deficit was the third biggest one on record. Now, and why is that? We cannot get around the fact that despite the tariffs, the U.S. economy is an economy which consumes a whole lot of goods and services from abroad. The consumers, by and large, and relative to the rest of the world, have a large and very strong purchasing power, and they have a very strong appetite for consumption, and that means basically that yeah, even though there are tariffs in place, the consumers, or at least some of the consumers, will continue to import and consume goods from abroad no matter what. And so the tariffs, even though are a sales tax, which increases the price for a large portion or a significant portion of the consumers in the United States, it still does not matter. But yeah, we'll continue to focus to get more focus on this on the tariffs, as you probably imagine later on in the video. Now the GDP. This also came on Friday, yesterday, and this was a big shock because it largely undershoot the expectations of analysts. There was expecting a 2.5 increase annualized, but instead it came 1.4, and as you can see, it's a large cry from the 4.4 increase from Q3. And looking here at again at the website of the Bureau of Economic Analysis, this is of course a development that of the GDP that took course over the year. There was a shrinking of the U.S. economy, GDP for Q1. Again, understandable. Consumers and companies were front-running the tariffs. They increased massively the imports. Imports contribute negatively to the GDP, so that's why this happened. But then again, when the imports were more normal and this effect was normalized, again, strong growth continued. But here, the contributions from each of the figures for the real GDP, you can see that again consumption remained strong. Investment also did a quite good contribution. Again, that is most likely the investment is also being pushed by companies which are basically investing in AI and infrastructure that will support the development of AI, of the AI economy, which includes, of course, the building up of data centers. The government had quite a negative contribution. That means that most likely, and I assume this was the case, I'm not sure if this says in here. Yeah, so this is basically the crux of this report. Increasing consumer spending reflects an increase in services that was partly offset with the decrease in goods. Decrease in goods, probably because of the tariffs, probably because the tariffs target for the most part the goods. Within services, the leading contributor was the increase in healthcare in other services. Yeah, healthcare again is not particularly value adding, but still it counts towards the GDP because it is an expense. Increase was for the other services with international travel. All right, so this is not also as much value added. Increase in investment, increase in intellectual property products, private inventory investment, and equipment. Again, this can be also to do with, as I mentioned, when it comes to equipment and private inventory, this could be also be related to AI. Increasing intellectual property, research and development based on the Bureau of Labor Statistics, and R&D. Yeah, again, Census Bureau, trade and manufacturing, partly offset with decrease in retail trade and information processing equipment, consumers and peripherals based on manufacturers' shipments from the Census Bureau and the Bureau of Economic Analysis. Yeah, all right. So this is still good. This is still a good sign for the economy, basically. But we'll have to wait and see if this momentum when it comes to the investment will continue for the next few quarters. Now, the decrease in government spending, this is because both non-defense and defense consumption expenditures for employee compensation decline. Again, this has to do with the layoffs that the government did, and this obviously has a negative impact on aggregate demand because less people employed by the government, unless these people are also employed in the become employed in the private sector. So there are less paychecks being paid, less personal income, and so this is not this does not give a positive contribution to the economy unless it is these people are absorbed by the private sector. Decrease in exports reflected by the ITAs. So yeah, all right. Now, this was of course a big shock. Now there's a note here about also the government shutdown, because which has to do with the shutdown occurred between October 1st and November 12th. This has a negative impact for sure, but still, given the fact that this was already being accounted for in these estimations of 2.5%, the 1.4% was still a very underwhelming figure. And now, coupled with this reading of the GDP, this is still a preliminary reading, the PCE, the personal consumption expenditures, were also released for December, and this was also not good news. And the reason for that is the headline, both on month on month and year on year, slightly increased, and this is also bad because with this combination of slower growth and higher inflation, the double mandate of the Fed becomes much more difficult to manage because they cannot lower interest rates because this will fuel inflation even further. But if they increase interest rates to tame this inflation, they will risk pushing down the GDP even further. And so this becomes a very complicated matter for the Fed to manage. And yeah, as you can see also here, this is even more serious because the core, which discounts, of course, the more volatile elements such as food and energy, also increased in the same way. And in the case of year on year, it touched 3%. This was according to the expectations nonetheless, but still, it's a move in the wrong direction. And here, looking again at the report, you will see that this remains quite sticky across the year, with a slight tendency to continue to increase over the past couple of months. And keeping in mind that also personal income readings were released, you see here that despite the increase in December of personal income and also on disposable income as well, in terms of real disposable income, there was no increase, and especially because we have the PCE increasing from a slightly higher rate than the personal income, and so that's why in real terms there was basically no increase or no improvement in purchasing power by consumers, and so which means that this increase in personal income basically does not buy any more goods and services than in the previous month. And this is of course something that needs to be a concern for the administration. Now here, looking at changes in monthly consumer spending, you can see that the biggest increase was in housing, healthcare, financial services, recreation services, and here you see that for the most part these are relatively many of these components here are essential services, housing and utilities and healthcare. And here at the bottom, the changes in monthly consumer spending, so meaning where the consumption was reduced the most: motor vehicles, other non-durable goods, and other durable goods, clothing and footwear. So these are you see here motor vehicles and parts, other durable goods, other less important non-durable goods. These are not counting here with clothes and footwear, but these are some of these components, especially motor vehicles and other durable goods. These are goods that are more related or more correlated with the level of consumer confidence in the economy, and this also gives you a sign that consumer confidence is not in a good place. And this also has to do here with this consumer sentiment, which continues to be rather low. I'm showing in here, the consumer sentiment was stagnated in February, and here you see that stagnated this month, very little change. Index components, insignificant movements this month. Overall, consumers do not perceive any material differences. Now, about 46% of consumers spontaneously mention high prices eroding their personal finances. Readings have exceeding 40% for 7 months in a row. Sentiment is 13% below a year ago and 21% below January 2025. Now, this is interesting. Views vary considerably across the population, and this supports the theory that has been thrown around, that the U.S. economy is becoming a very much a K-shaped economy, in which one portion of the population continues to do very well. Mostly, they have their wealth tied to appreciating assets such as real estate and stocks, and the other half of the population, which does not have these appreciating assets, don't hold these appreciating assets, they are seeing their personal situation and economic situation ever more strained and precarious. And here you see that a sizable month-on-month increase in sentiment for the largest stockholders was fully offset by the decline among consumers without stock holdings. This is, in a nutshell, a complete picture, a comprehensive picture, or should I say, the definition of an economy which is developing in a K-shaped pattern. Similar divergence was seen across income in education, when higher income or college-educated consumers exhibited increases in sentiment, while lower income or less educated counterparts did not. With their much stronger income prospects and investment portfolios, wealthier and higher income consumers feel better insulated from any possible risks in the economy. And this is not a beautiful picture, or not a pretty one, because as you see here, this is the consumer sentiment, which is from the Michigan Consumer Sentiment Index, and you see here with data all the way from the 70s, we are pretty much touching all-time lows in terms of consumer sentiment. And yeah, this is of course not a pretty sight for the American consumer, and by extension to the economy. And again, this is the same thing with the overlaid for the GDP and with the moving average. But now, moving on from here, again, another sign that the U.S. economy is not doing well. The flash services and manufacturing PMI also were released, and this is the news piece over here. They declined to 51.2 in February, and the services decreased to 52.3. Now, above 50 is still an expansion, but it's at a slower pace. And apparently, this was a result of a combination of weakened demand, high prices, and adverse weather colluded to dampen business activity in services in February, resulting in the slowest expansion of output for 10 months. What this basically means is that most likely, if this continues like this may be a prelude of a bad GDP reading for Q1 2026, much in the way of what we saw here for the Q4 2025. Customer demand growth has softened, with fall orders even falling in factories, curving jobs growth to a crawl across both manufacturing and services. Well, so much for the attempts of the current US administration in imposing tariffs to force manufacturers to relocate back to the United States. This has not been working out, to say the least. Now, with this out of the way, there are other topics that I want to touch upon, because even though these were not part of economic releases, this will also affect the performance in our challenge, not only for now, but most likely for the coming weeks as they develop. Now, I want to touch upon on this because this is the website of the Federal Reserve Bank of New York, which released a study in which they say that basically you can also look for this on their website, but what they say is that the American consumer is paying the brunt of the tariffs. And looking here, let's see, not like a 3 deep stock. All right, so here we highlight two main results. Bring this here. First, 94% of the tariff incidence was borne by the US in the first 8 months of 2025. The current US administration said that for years other countries have been, quote unquote, ripping the US off, and so they must pay for the tariffs. The tariffs should be put in place to force the other countries to pay for bringing their goods to the United States. Well, apparently this has had the opposite effect. Importers, meaning companies, have passed through most of the tariffs, the value of the tariffs, to the end consumer, which is the American households. 94% of the tariff incidence was borne by the US in the first 8 months of 2025. This result means that the 10% tariff caused only a 0.6 percentage point decline in foreign export prices. Now, the tariff pass-through import prices declined in the latter part of the year. This is a larger share of the tariff incidence was borne by foreign exports by the end of the year. In November, a 10% tariff was associated with a 1.4% decline, suggesting that an 86% pass through to US import prices. So this means that 86%, and this was after the first 8 months, all right, because in the first 8 months were 94% of the value of the tariffs was passed to the consumer. In November, 86% was passed to the consumer, because these import prices were of course are reflected in the end consumer price, the price that everyone pays for the goods on the shelves of supermarkets and stores, whatever. Given that the average tariff in December was 13%, our results imply that US import prices for goods subject to the average tariff increased by 11%, right? So just because of the effect of the tariffs, just because of the effect of the tariffs, prices of import goods increased by 11%, more than those for goods not for subject to the tariffs. So the effect of the tariff, it increases 11% of the prices to the consumer of those imported goods, of course. These higher import prices cause firms to reorganize supply chains, as suggested by the finding presented in the two charts above. These are the authors of the study, and here, as expected, here you see that this is the White House economic advisor Kevin Hassett saying that the authors of this study should be disciplined, so they should be punished. Basically, this is the worst paper I have seen, and yeah. I read this news piece beforehand, and I could not help but, yeah, of course, smile because what is here is I would say, I would even go as far as saying that the Nazi German Minister of Propaganda would have to learn so much by if he was alive by this person, but by learning through this person. But here, prices have gone down. Inflation is down over time. This is somewhat, of course, this is true given the spike in 2022. Import prices dropped a lot in the first half of the year. That level off, and real wages were up $1,400 on average last year, which means that consumers were made better off by the tariffs, he said. So consumers could not have been made better off by the tariffs. Well, I guess this picture combined with this picture says how much of a BS this actually is. I mean, there are no words because this is a White House official. People should be serious about when they make public statements. And I think, yeah, if there is one thing that lack in this statement is being serious. This is a joke, basically. Now, moving on from here, because of all this, I don't want to spend too much time on this because this is still an uncertain topic. We don't know what's going to happen, but in response to the Supreme Court having struck down the reciprocal tariffs that were leveled from April onwards, the US president announced a new 10% global tariff, but according to the ruling of implementation of tariffs, I think that's what this is what is meant. The Trade Act of 1974, trade tariffs created using that statute can last only 150 days, and then an extension must go through the Congress. So even if this is an executive order, which is, any further extensions past these 5 months, give or take, will require congressional approval. We'll see. We don't know what's going to happen. This is a topic which will continue to develop over the next couple of weeks, so there's no reason for me to spend too much time on this. Yeah. Now, even so, I want to remark this. I don't think this is really appropriate for a head of state. I think this is the decision is terrible. It's an embarrassment to their families. Well, yeah. Say what you will. I don't have to. We do not want to work with the When asked at the Friday's press briefing why he did not, the U.S. president did not want to work with the legislative branch, Trump said, "I don't have to. I have the right to do tariffs." Well, in a democracy, you don't have a head of state which says this kind of statements. This tells all about you need to know about the person you're dealing with. This is what happens in dictatorships. That's all it can be said. Now, the last topic I want to touch upon is also this one. This also affected the markets over the past few days because, especially on Friday yesterday, there are an increase in tensions about whether in between the US and Iran and the potential prospect of military action by the United States. So this will also is already having ripple effects on the oil markets with an increase in oil prices, and we will have to see what's going to happen in the next few days. But based on the military buildup that the United States is making close to the shores of the Iranian coast or on the Gulf, well, I don't see why there won't be any military action out of this, but we'll see. Now, one last thing that I want to touch upon here. Let me just refresh the page to make sure that we are not logged off. One thing that I want to mention here on the PCE, yeah, PCE is here. So sometimes I get questions about what's the difference between the PCE and the CPI. Basically, the CPI, the Consumer Price Index, is based on the basket of goods. Of course, this basket of goods has specific proportions of different goods. They are updated over time, but still, it's a one picture, a one snapshot of a basket of goods at a given point in time, and see how much this basket of goods increased or decreased in price over time. The PCE, and that is why the PCE is more reliable for the Fed, is that the PCE reflects the substitution effect that price changes have on consumers. Because, as you know, some goods and services are substitute from one another, and you can in response to the changes in price from one good, you can buy more or less of that good, of course, obviously, but you can also increase or decrease the consumption of a substitute good as well. And so this is why the PCE, because the PCE reflects this substitution effect, reflects that the fact that consumers may shift their preferences from one good to the other in response to the price changes, because the PCE captures this effect while the CPI does not capture. That is the reason why the PCE is seen as a more reliable measure of the actual inflation or lack thereof that consumers are facing when they go shopping, and that is basically the reason why. But yeah, after unpacking all these events, that is also, as you can imagine, the reason why we had such volatility here. These are the cues. We are also exposed to IWM now. Yeah, this is anything but smooth sailing, as you can see. And particularly in IWM, because this situation of the tariffs being struck down by Supreme Court and the global 10% and what's going to happen, this has a bigger effect on IWM because small capitalization companies have less flexibility in their supply chains. It takes more work for them to adapt their supply chains, and this whatever comes out of this will have a bigger impact on small caps. And so also the situation of the interest rates, the future interest rates also affect further the small caps, because they are more dependent on loans that are indexed to the Fed interest rates. So yeah, you see that this volatility is no mistake, is real. This is really something that really affects this market. Now, when it comes to the trades themselves, ARKK, there's nothing much to say about this. This, of course, being a technology index, it also, and it's of course quite volatile. You see here, even though it showed a little bit less volatility, but still, it's quite correlated to the Qs. So there is not much to say about this. When it comes to the trades themselves, we decided to do something a little bit different here. These, as it was obvious since the last video, these calls expire worthless. This is the calls we had on the queues. So we rolled over not to the end of the current week because there was no premium basically to be captured. The price of the queues was hovering around 600, and with only 3 days left in the week, and with the strike price that we want for 630, there was basically no premium to be had. We could only get 2 cents or 3 cents out of the calls, so there was no reason for us to do it. So we extended for another week, for another full week, and so these calls will expire next Friday, and so their volatility will capture these jobless claims, the PPI, which is not as significant as a CPI, but still it is somewhat important because the PPI, the changes in PPI are very likely to be reflected at the CPI further down in the value chain. But apparently here there is not much to be, there's a lot of Fed speak apparently, but still there is no further, not much to be concerned about here. In terms of earnings, we'll get to that, but because there's a big one coming. But here we also decided to go ahead and try to further down bring further down our cost basis of the ARKK. Here we sold a put, another put here on with a 63.5 strike price again, because if we do this and we get assigned our cost basis for the shares, 400 shares that we would have if this put is assigned, would have a cost basis of 72.5, which is much more palatable for us. And we rolled over the put we had already sold last week because it was already at 2 cents with 1 day remaining. And here, this is the put. That's why we still managed to collect a return of 90%. The queues that the calls that expired this past Tuesday, this had this meager return, which is of course nothing to write home about. This is pretty bad for us. And now, when we rolled over, we got this one, but not for the same for the end of this week. It will go also to the end of the next week. We received 22 cents. I think this will give us also a return around the same area or the same range, 18-17%, which is nothing great, but the calls we had on IWM at some point were in the money this week, but then they came further down, so they expired with no value. And also we decided to use the remaining of our buying power, and we sold a put on SILH. This is basically an ETF that tracks companies on silver, given what is happening currently on metals. Now still, as you see here, the volatility is extremely high. This is something that we have to be very careful about it. But given the fact that we did this yesterday, this was only a 1-day trade, because they sell options for every week, and we sold a put that would expire at the same day, Friday, with a 34 strike price. It gave us a very good return. We still collected here 13 cents. We paid 80 cents on fees, but then we let it expire because this had no value. It expired, and we got a return of close to 100, annualized return of close to 131%, which is very good, of course, but it reflects basically the volatility of the ETF. Now, with all this in mind, so 17, 19, 20. So it's from here, and we only received we only collected a little bit more than $461. Now we have still a lot of open positions, all right, and some of I would say all of these will in all likelihood will expire worthless, but we cannot say for sure, and we don't know if we let it expire or we buy them back early. So this is what we collected at the end of this week, and these are closed positions, so we will see. In any case, whatever happens with the options we still have available, we will still be happy. For sure, this will expire worthless. I don't see this making a jump of $22. It would be nice if it happens, but I don't see this making a $22 jump in 5 days with so few events coming. And yeah, if this call is assigned, so much for the better. And if this put is assigned, it will bring us costs down further, so all good for that. And if they all die, this is the default scenario, so we'll just open new positions, equal positions for later on. So whatever happens, we will be okay. And yeah, this is pretty much it. But again, one last thing that I want to mention, it's the earnings, is that we will have on next week, and I believe it's on the 25th, and let's see what it is, because I'm sure that this will be around here, which is the Nvidia earnings. Let's see. Well, Snowflake, this is probably also important. Yeah, Nvidia is here right at the bottom. And so this will be the main highlight for the week. It will take place on Wednesday, so our calls for the queues will for sure are capturing this event. And yeah, we will have to wait and see what's going to happen, but so far I think this is the only real earning release that will be for sure market moving. Yeah, for the most part, this is it. This was a pretty long video, and I will also put in the description below the video about the tariffs that I did last year, showing that basically everything that is going on, the conclusions of this study by the Fed, is something that I already mentioned in that video, because the video was precisely about the tariffs and how bad this would be. And so yeah, I will put this video in the description down below. But so far, pretty much this is it. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we'll reconvene on next Monday morning, Monday evening, or Tuesday morning to start the week number 83 in this challenge. And yeah, I'll see you there.